Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to the Through the Noise podcast. Now, it's been a week of record highs across major equity markets, and we've seen indices in the US, Europe, and Japan all set new record highs. Now, while that's arguably less unusual for a market like the US, the one that jumped out to me the most was Japan's Nikkei 225 index, which finally regained a new all-time high after 34 long years. That's, of course, overcoming what Japanese traders often refer to as the iron coffin lid, with much of that coming this year, with markets rallying over 17%, at least in local currency terms, on improving corporate governance. Now, the key question, of course, is can these sort of rallies continue? So to discuss this question and more, we're joined by what's a familiar voice on this podcast, Fook Hien, who's a senior investment strategist at the CIO office. So welcome, Fook Hien. Thanks for taking the time to join us today. Let's start in China and actually Japan equity markets. We've seen in recent days, at least, they've started to outperform developed markets after a long period of underperformance. In your view, what's driving this? And could it be the start of a new trend?
Yeah, so we've seen that since the Lunar New Year, we have seen China and more broadly Asia ex-Japan markets. They're supported by a strong rebound in China's domestic tourism during the holidays and another raft of stimulus measures from Beijing. There is a rising chance of a tactical upside in China and Asia ex-Japan equities in the near term as Chinese authorities roll out measures to revive consumer and business sentiment. Nevertheless, some investors are still waiting for more forceful demand-side fiscal and credit stimulus measures to revive the property sector and boost business confidence before we see a sustained upturn in China equities. China's upcoming National People's Congress in March will be closely watched for further measures. If you look at it year to date, US and Japan are still the clear two outperformers, and they remain our preferred global equity markets. Japan equities, they continue to be backed by sustained foreign and domestic inflows. Investors have been attracted to the market by strong corporate earnings at the exporters who are benefiting from a weak Japanese yen. And then there's a downturn in China equities and relatively attractive valuation versus US equities and other investor-friendly measures, such as improving corporate governance and state incentives for households to invest in domestic stocks. US equities is still the leader year to date, and it is hard to see the US giving up leadership easily, especially with the continued boom in our preferred technology and communications sectors. Also, the Fed rate pauses ahead of rate cuts, they have historically been good for global equities and US equities in particular. Our view, we expect the Fed to cut rates in June, which means that the current Fed pause would be slightly longer than the average pause of 9 months over the past 30 years. And so this leaves room for further upside in US equities. In China, while we await further policy measures, we would add exposure to technology, communication services, and consumer discretionary sectors. These are likely to benefit the most from policies to drive innovation, to boost China's competitiveness, and they also likely benefit from a gradual upturn in consumer demand.
Thanks, Fook Hien. Maybe just on that point you ended on China, perhaps we can just dig a little bit further into that. Can you help explain to our listeners a little more on the recent policy easing measures and specifically what you see as the implications on Chinese equities and dollar bond markets?
Yeah, I would highlight three supportive policy measures that were reported in China last week. Firstly, the PBOC, they cut the 5-year loan prime rate, which is the key mortgage reference rate, by 25 basis points. And this is the most on record. Second, the banks are reported to have approved 124 billion Chinese yuan of loans for select developers. And third, the authorities, they increased scrutiny on your domestic quant funds for allegedly contributing to an earlier equity market sell-off. So, in the context of bonds, the first and second measures are more significant. China's property developers' US dollar bonds, which are mostly rated high yield, they are likely direct beneficiaries and they've rallied 2.1% this week. However, while these targeted policies are positive at the margin, we believe they are insufficient to bring about a sustained price recovery for the sector's bonds. First, your housing prices continue to fall, keeping buying intentions depressed. And second, the loans can be used only for unfinished property projects. And third, the weaker developers, especially the privately owned ones, they're still likely to face difficulty accessing stable financing. By contrast, we see better opportunities in other sectors within Asia high yield bonds, such as Macau gaming and India renewables sectors. Macau's gross gaming revenue recovery is likely to extend in 2024, while the India renewables sector should continue to benefit from a positive momentum in the broader economy. Now, for equities in China, we believe the latest set of measures they signal further easing is likely in the pipeline, which should in turn help in putting a floor under China equities. If you look at the Hang Seng Index, it's experiencing a double bottom support at 15,400. Positioning is light compared to US equities, and the mixed messages on the US economy are likely to extend uncertainty over Fed policy, which is likely to prompt some short term rotation into China equities. That said, we continue to believe that a significant improvement in the China economy is needed to sustain any market rally. Deflationary headwinds are one risk. Your producer and consumer prices are declining, house prices are falling, and home buyer sentiment remains depressed. And the relatively elevated real interest rates are another related risk.
Okay, well, maybe shifting gears a little bit, another key event, of course, is the US earnings season, which is reaching a point of arguably it's running its course now. I guess based on what you see from the earnings season, what's your view on growth stocks, and does it create any buying opportunities in your view?
Yeah, we've seen about 80% of companies in the S&P 500 index have reported the Q4 earnings with encouraging results. So according to LSEG IBIS, about 80% of reporting companies have beat consensus earnings estimates, which is above the long-term average beat rate of 67%. The earnings surprises have been broad, with all 11 sectors enjoying a positive earnings surprise. So earnings in Q4 of last year are expected to grow by 9.6%, up from 4.7% expected at the start of the year. Similarly, for the full year 2023 earnings growth has been revised up to 4% from 2.9% previously. And this higher base has led to 2024 earnings growth being revised down to 9.5% from 11.1% previously. So, with robust earnings growth and an expected decline in bond yields, we are positive on growth stocks, albeit with a preference for specific areas such as cloud computing, AI investments, and the semiconductor industry. We like the technology and communication services sectors, which we expect would outperform the broader market over the next 6 to 12 months. Besides these growth sectors, we also like the healthcare sector as part of a barbell strategy to provide defensive exposure in the event that US economic growth weakens. However, we see stretched investor positioning in healthcare at present, and we would prefer to wait for a pullback before considering adding exposure.
All right. And finally, maybe just on investment grade corporate bonds. We've seen in recent weeks that yield premiums have become increasingly expensive versus government bonds. But in your view, are they still worth adding at these levels, particularly relative to cash?
Yeah, the investment grade corporate bond yield premiums over government bonds are now close to historical lows. We attribute this tight premium to one, a strong demand for high quality corporate credit, and two, stronger than expected earnings releases on average. So the nominal yields remain at an attractive level given the higher benchmark government bond yields. So the investment grade credit fundamentals have remained strong with rating upgrades continuing to outpace downgrades. A sharp economic slowdown remains a risk to credit quality, but the strong corporate balance sheets should help offset the impact of any mild recession. Therefore, despite elevated valuations, we believe these investment-grade bonds they remain compelling, especially relative to cash. While cash yields appear optically comparable with those on the investment-grade bonds, your high-quality corporate bonds offer the ability to lock in yields for a longer period of time. And in addition, there's the prospect of capital gains from falling US dollar bond yields. So we hold a neutral view on the developed market, investment grade corporate bonds, and the Asia US dollar bonds. This is an allocation that we believe balances the risk with the reward.
All right, I think we're about out of time now, so maybe we'll end the podcast today on that note. So thank you, Fook Hien, for taking the time. But as always, maybe if I can just sum up my key takeaways from our conversation today. I think first off, of course, the US and Japan still clearly are preferred regional equity markets, and particularly the US, given where we are in the Fed and earnings cycle. Second, of course, a lot of focus on Chinese equity and dollar bond markets with the outperformance in recent days, but quite a bit of uncertainty whether policy measures so far have been sufficient to put a firm floor under both asset classes. And third, investment grade bond valuations, yes, increasingly elevated, but still compelling versus cash. So thank you, Fook Hien, for joining us this week. And thank you, listeners, for joining us on this week's podcast. We hope you enjoyed it, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.